Satish, good morning and thank you for joining us. Satish, the Monday high is turning out to be the highest point for the day, the highest point for the month. Do you think bulk of the political adjustment is behind us and we have a top in place for the rest of the year?
Yes, I think we are probably done with the election results, so we should probably look at corporate results for now rather than election results.
Satish, a whole lot of nervousness ahead of the RBI as well as the Fed meet come next week. And of course, today post-market hours, we've got the IIP data as well slated. And all this comes in the light of Raghuram Rajan being extremely hawkish, saying inflation is still pretty much a concern, as we heard him yesterday. What's the sense that you're getting right now? If indeed it's a 25 bips hike that we see from the central bank this time around, and perhaps, some hawkish tone from the Fed as well, could it be an extremely vicious day then for the markets?
I think in terms of the short term, yes. In terms of the medium term, no, because corporate results are improving across the board, both in US and Europe and other emerging economies as well. So I don't think that there is any reason for panic on that one for that particular event. Probably, yes, from a trading perspective, one has to time it better, but I wouldn't get worried unduly if these two events were to take place as an indication of a Fed taper or a 25 basis point increase here. And also in terms of, from a corporate India perspective, CapEx is at a multi-year low. We may probably get into 2015 as well with a very weak CapEx profile. But I think we are sequentially improving and we need to keep our eyes on that.
Satish, is there a serious case for India now to outperform other emerging markets? Because out of the two big concerns, elections and tapering, for the moment the political concern at least has taken a backseat for next one more quarter.
I think we are probably done with the outperformance per se because we have rallied pretty hard and we've had record inflows as well. In terms of FII inflows into the region, India has a much higher share than what others would what we should actually have received in terms of weight, etc. So I think we've already done with that level of outperformance. We've got $17 billion this year, and I look for some consolidation before the next rally starts.
Satish, so what's the sense that you're getting in the near term? You think the Diwali high of around 64.15 thereabouts was the ceiling, at least for now?
I think that's probably it for now, and then post-March, when the actual elections and the sentiment improves, we will see that happening, probably breaking into new territories. Also in terms of December, sorry.
No, go ahead.
Yeah, in terms of the December results, which we will see in January, we'll probably have to see some disappointment in numbers coming through because there is a fair degree of inventory adjustment on account of inflation and the depreciation of the currency. So we'll really have to see which way it goes and then take a call from there.
So are you making a case that even genuine investors should not invest right now, and you think markets somewhere are looking slightly frothy, and as the year unwinds, investors will get better entry points to allocate capital?
To some extent, yes, but I think there is deep value in midcaps, and one should look at selective midcaps where the fundamentals of the businesses are very strong and cash flows as well, and valuations are extremely attractive. Those stocks I don't think we can time to perfection. On the large cap space, yes, perhaps we will get a better entry point.
What is an ideal entry point? 5% lower, 10% lower, or 15% lower?
I think we should be probably looking at 6,100 to 6,000 levels before we start accumulating again and building up a portfolio.
You mentioned that you're bullish on mid-caps, but what drives any stock price in the short term or perhaps in the medium term is liquidity and flows. At a time when domestic institutional investors are selling and foreigners are only buying into 15, 20, at max 25 stocks, who would buy into these mid-cap stocks? Okay, so there is a deep value argument, but that deep value argument could remain for next 2 or 3 years.
To some extent, yes, I agree with you on that argument. But at the same time, when your dividend yields are rich and your cash flows from operations are good, I think we should hold on to these stocks and increase allocation as time progresses, because when liquidity conditions improve, these stocks could give very high returns, and therefore we should be prepared for these.
Okay, let's look at individual mid-cap groups now. Satish, and from the mid-cap space, there are 2 groups which are clearly standing out. Number one, the entire NBFC space. So you've got Mahindra Financials, then there is strong price action even in Bajaj Finserv, and then you've got the tire space. Do you track both of them with the magnifying glass, the NBFC space and the tire space?
Yes, the NBFC space, I think in terms of valuations, are fairly rich for now. Considering that we've had a supernormal growth for the past 3 to 4 years, I think we should consolidate our position, if not trim some positions there. As regards the tire space, we've seen the benefits of lower commodity prices coming through. We've had CAT as really rocket. I think in terms of cash flows and valuations, JK Tires also stands out as a deep value stock. And consequently, we think that there is probably a little more steam in the tire space, because they're trading at 2 times cash flow or 2.5 times cash flow on current nominal earnings.
Satish, what is it that you're feeling now about the banking pack? And again, it's been really all over the place. Days the market's gone high, the banking pack has moved up with the market, but of late again we're seeing that dichotomy wherein the private lot does well, PSUs take a beating, come back to the fore.
I think the valuations in the public sector space is still very attractive. The NPL problems that we've seen in the public sector banks may continue for a quarter or 2, so there will be some degree of volatility. But you could always use that volatility to your advantage and probably buy many of these PSU banks at 0.6 times or 0.5 times price to book. On a structural basis, PSU banks will still underperform private sector banks, but from a trading perspective, public sector banks do offer a significant advantage.
Satish, you know, a retail investor asked me a question yesterday, and that's sort of has stayed with me. And if the basic bullish assumption for 2014 is that the index could give a 10-12% appreciation, why should one invest into equities at all? In tax-free bonds, they give you 9% short return.
I think without doubt tax-free bonds are an attractive investment option as it stands. And in terms of equities, the issue is that it can never be 10% on the dot. It could be 15 and 18%, and then it drops down by 8%, and then you get a 10% over the year. Obviously there will be investors who will invest after it's moved up 18% and lose 8%, and there will be investors who make 18%. So it's all as to how you want to time it and how you want to play it really. So and also in terms of the fact that we are moving off a long-term economic slowdown, I think the 10% expectation may be breached on the upside, especially as we enter closer to 2015-16. So I think the 10% is conservative from expectations.
Like your optimism there. So let's look at individual Nifty 50 gainers then. 3 standout performers for 2013, Satish, are HCL Technologies, Sun Pharma and TCS. What does 2014 in store for these 3 winners?
I think TCS is fairly valued at these levels. It will be difficult for them to outperform the markets, especially in terms of the kind of valuations that they command, unless they make some inorganic acquisitions. That's one. The same holds true for HCL Tech. Its valuations have moved up considerably. Sun Pharma continues to be rich in valuations, though the growth rates have been fairly good and strong. And I do not think that these sectors will probably outperform in the next year as well. I would still back L&T, BHEL, and to some extent Tata Motors, or even a name like Tech Mahindra.
Well, Heineken yesterday hiked its stake by nearly about 1.5% via open market purchases, so it now holds about 39% nearly of United Breweries, which by the way is more than the promoters. So while UB held out by about almost 2% yesterday, you had UB Holdings, which surged almost about 7% in trade yesterday. Today as well, it's just about marginally in the green. And of course, United Spirits has been a darling with most investors. Satish, what is it that you like out of these three names, and especially with the kind of developments we've seen off late with the company?
I think United Spirits still continues to be an attractive investment over the medium to long-term perspective. And the leverage that they can show in their earnings is tremendous, because the three shifts that are taking place are very visible in this stock. One is from the unorganized liquor market to the organized liquor market. And you are seeing premiumization, and you're seeing the fact that demographics work in its favor. So from a secular, longer-term perspective, United Spirits is a must-hold in any portfolio. I would still continue to hold that. United Breweries is fairly rich in valuations, but also fit into all these three categories that I mentioned. So I would probably wait for United Breweries from a correction point of view, either on price or time, and then pick that up as well.
Satish, for the year 2013, we've seen a very polarized kind of a market. Index has done nothing. We've only seen price action in IT, some pharma, and select NBFCs. What do you think will be the big story, the big trend, or the big money-making idea for 2014? If your core belief is that midcaps will make a comeback, then which are some mid or small cap names you have bought into or you're buying into?
I think in terms of some of the mid-cap names that we mentioned, we liked JK Tyres. Clearly, it's a large company with tremendous cash flows. The cash flows for the current year would be almost 100 rupees per share. It's trading at 160 rupees. At 1.6 times price to cash flow, I think it offers a fairly attractive entry point. So that's something which we like. We also like some of the smaller pharma names such as Marksans, which seem to have shown a turnaround. It's still early days as yet, but we need to monitor that. And in terms of some of the other ideas, Ashok Leyland will also feature as one of the good, strong turnaround stocks. And we also like Wapco Wapco TVS as well. So Wapco is something which will benefit from the improving CV cycle, exports, and is reasonably priced as well.
Like Chennai-based companies, don't you? Ashok Leyland, Wapco, regional preference.
There is a natural bias, I admit.
I still don't compare it to like DLF though. But anyway, Satish, what about Telecom? Is there anything that you like out of the Telecom space?
I think Telecom has a huge operating leverage, and the fact that 70% of the industry is now moved into private hands indicate that pricing power could be coming back. And therefore, it is natural to believe that Bharti would be a beneficiary. The only thing that worries me about Telecom is the rapidness of technology. You have Viber, you have WhatsApp. A lot of these apps actually can be used on Wi-Fi and reduce the need for telecom, especially for the heavy users. So I think that's the only dilemma that I have, but otherwise Bharti would be one of the key beneficiaries by this consolidation that's taking place in the industry.
Getting the iPads which everyone is using and the 3G data card which is required to use all those iPads.
Yes, I think data is becoming a very, very important part of the telecom industry, and it's expanding very, very rapidly. Tata Communications would be a beneficiary of that, as well as the telcos as well.
Do you like Tata Communications? That has been a very big performing stock, and I wonder why, because there is no clarity on the land deal. Not that the global business for Tata Communications is doing something great. It is no longer a cheap stock, but everyone on the street, at least the smart guys, still own it.
Tata Communications is a play on wholesale data. It's not a play on retail data. And to that extent, the fact that data, their operating profits from data has crossed that from voice is one of the reasons why the stock has been re-rated. Data growth rate could be upwards of 20-25% going on for a fairly long period of time, given the under-penetration of internet in the country. And these are some of the reasons why Tata Communications could continue to outperform in the market.
Satish, markets, they always tend to factor in events and good news ahead of the actual, scenario. If Nifty goes to 7,000 or even, let's say 7,200 before the general election, would you be a seller then?
I think I'll have to review the conditions then, because money flow is very, very slow across the world at this juncture. And we all know that the 2008 peak that we had was on the fact that money flow was moving around very, very rapidly. So if the money flow is still sluggish and we still reach 7,000, I will hold on a little longer. But if 7,000 is reached because of huge bubble-like environment getting built in, I would be a seller. That's point number one. The point number two is, tactically, people are under-owning equities across the world. And there is going to be an increased allocation towards equities as time progresses, because most people are risk averse. Most people will start seeing some losses in their bond portfolio as well. So there will be money being pulled out of the bond portfolios and put into equities, more as a hiding place rather than conviction at this point about the longer term prospects of the market. And that itself could set off equity rally to a new high.